Did you know the majority of people think that they're supposed to sell their home if they want to buy a second home? Today, I'm going to show you a strategy that a lot of home buyers and investors are doing so they can get another home without having to sell their first home. And on top of that, we are able to do it that we make the down payment very minimal. I'm talking about 5%, not 20%, not 15%. I'm talking about 5% down if you want to buy another home without having to sell your first one. Today, I'm gonna show you the strategy. Stick here till the end because I'm gonna show you tips and strategies of how you could do this without having to empty out your pockets, putting a huge down payment. You can if you want, but I'm gonna show you a strategy of what people are doing to get their second home without having to put a huge down payment. I want to welcome you to Mortgage Ace Hacks. This is my podcast where I'm going to talk about mortgage lending, real estate, different investment strategies, ways how we could increase your portfolio to wealth. I am a loan originator. I've been doing this since I was 17 years old. Can you believe it? A lot of people get surprised of how young I am, or especially back in the day, how young I used to be. But like I always tell people, let the experience speak for itself. We will get your loan closed. And today we're going to talk about how you could purchase another home without having to sell your first home. That is correct. We're going to show you how you could purchase your second home if you already have a first home without having to sell your first home. And we're going to show you how to do it without depleting your pockets, without putting a huge down payment. We're going to show you how you can buy your second home with only 5% down. I have a client that I recently closed and was able to help him out with his home loan who came to me looking for a second opinion. What he wanted was he already had his first primary home. His family grew, he had some kids, his family got bigger. He wanted to upgrade and get another home without having to sell his first home because he knew the equity and the appreciation is going to keep growing. He just wanted to keep building his real estate portfolio. So he went to, a lender down the street and they pretty much told him, "Hey, in order to do this, you have to sell your first home in order to get your second home." That wasn't what he wanted to hear. So he went with his gut and got a second opinion. He came to me. That's when I was able to structure his file and work with him to get him in another home without selling his first home and still only putting a small down payment. We're talking 5% down. They were also telling him he had to put 20% down. That's not the case. I was able to get him a second home with only 5% down. Now he upgraded. He was able to lease off his first home and he now has more than one property. So that was able to increase his real estate portfolio. So today I'm going to show you how it's done. I'm going to give you several key points that are crucial to this. The first one is the common error that people make. They assume that you have to sell your first home in order to buy a second one. That is a myth. How does it work exactly? Well, it just all depends on what lender you're working with. We're all similar, but we're all a little different. It just all depends on how they structure your file. In this case, if you want to upgrade and get another home, we're going to have to offset that mortgage. And I will show you how that's done shortly. So, how is this done? Well, you got to make sure you structure the file accordingly. Is the bank or the lender looking at your current home as a debt, as a liability, and not as an asset? That was the common mistake that a lot of lenders make. They don't know the guidelines of a true Fannie Mae, Freddie Mac program. They don't know that you could rent out your current property. And in that sense, that kind of washes away that debt. And that way you're able to get another home putting as little as 5% down. And that's kind of like the whole tip and trick about this whole method is if you don't want to sell and if you qualify for a conventional and you only have one primary, then with a lease agreement, sometimes they even want a first check deposit. Sometimes we get away with the lease agreement. It just all depends if you're doing Freddie or Fannie. However, with a lease agreement, essentially we could cross out or wash out that debt so you qualify for your full buying power, only putting 5% down. Conventional minimum is 3% down, but that's only for first-time home buyers. Technically, you're not a first-time home buyer if you already have a mortgage. So that's why we deem for the next best 5% down. It's not that hard. Crucial documents that we need and how is this done the correct way is obviously, we have to go off of conventional guidelines. You have to, have a decent credit score. You have to be working, whether, it's self-employment income, W-2 income. It's even possible with some retirement income. The biggest thing is you're upgrading. You are upgrading. You have a house that's a certain size, you get another house that's bigger, and then you're able, whether it's you or your agent, they look up the rent area, the rentals in that area, and you give me a lease agreement, realistically showing the correct rent. And then usually rents are higher than the mortgage payment. That's why we always tell you it's cheaper to buy than to rent. And pretty much that cancels out your debt. And that way we're able to do it putting a little as minimum down payment. Now, that's called a property conversion, meaning that home is your primary home, but now you're renting it out. It's no longer your primary home, it's your investment home. And there are, pros and cons of doing that. Obviously, if you upgraded for your family and you buy a bigger home, awesome, great news, good for you. But you also still got to account for your old home since you didn't sell it or your home. You have to maintain it. It's your investment property. You just got to make sure that, your tenants pay on time, because the mortgage still under your name. If they don't pay on time, hey, you got to cover, you either got to get a replacement tenant right away, or you have to be able to cover both mortgages. End of the day, you want to make sure your credit's intact. The con, you get rental income. You get rental income, passive income. Let's say your mortgage payment's $2,000 on your home, and you could generate 3,000 a month. Hey, that's an extra $1,000 in passive income, rental income. It's you could use that to invest in other things. You could use that to pay down that mortgage quicker. In the end of the day, you're in control. We're also going to talk about something very, very, very important to the home loan approval process. So you might have heard it in the past. If you went through the process, it might be something first new to you. DTI. That's something I hear every day. It stands for debt to income, DTI, debt to income ratio. What exactly is it? And how does it affect you? I'm going to talk about it all because it's crucial. So you're applying for a home loan. I'm the loan officer. Of course, I want to help you out. However, I do not want to set you up for failure. I do not want to leave you house poor. We want to make sure that we put you in a sustainable, affordable product to fit you and your family's needs. We want to make sure that you're not broke eating beans the rest of the month because 95% of your income went to your mortgage payment. That's not what we're trying to do. So with DTI, it's like a safe layer, safe factor, risk factor that goes well into lending, meaning we have limits. Usually your debt to income ratio is the percentage of your income that's going to go into your mortgage payment. Then we also have to factor in the percentage of your income that's going to go into your mortgage payment and your other debts. That's what DTI is. Just the front ratio means how much of your income is going to go to the mortgage payment. Usually, we are capped at 45%. Okay. With back DTI, depending on the loan program, usually we're capped at 49% or 56%, depending on the loan program. Every program has different ratios, different limits of how much DTI we could stretch. Accordingly, though, on average, it's usually no more than 50% on average. We want to make sure that after you make your mortgage payment and you pay your other bills, you still have some money left to live. That's what DTI is. So, how does it make effect? Well, I'm gonna give you an example. Let's have two twin brothers, Joe 1 and Joe 2. They both make 100,000 a year. They make good income. They both make 100,000 a year. However, Joe 1, debt free. He's got no debt, nothing, not even a small credit card or nothing, no debt. Joe 2, he makes 100,000 bucks, but he just bought 2 new trucks. He's got credit cards maxed out, student loans. Oh, he's in debt. Well, they both apply for a mortgage. Joe 1's gonna get approved easily for 600,000. Easy, 600,000 based off his income. No debt. He's able to spend more on the housing payment. Joe 2, because he's so much in debt, even though he makes good money, that's getting sucked up monthly per his debts. He's not going to qualify. He's going to need a cosigner or he's going to have to pay off debts. The bank is not going to lend you more than what you could chew. Keep that in mind. We are not going to lend you more than we could chew. We're not going to set you up for failure. So we got to make sure that your DTI is within a certain percentage that you're able to cover the bills, cover the mortgage, and still live life. That's what DTI is, debt to income ratio. It's a protective factor for you. Another question we get is, how long do I have to live in my property in order to buy another property? Oof, that's a very question that we get asked a lot. And it honestly depends on the type of financing that you get or how you purchase the home. Let me give you an example. Let's just say you bought a home cash. You bought a home cash. You got it like that. Good, congrats. You bought a home cash. I bought this house. You live in it for a week, but then you don't like it. You want to buy another one. Cool, go ahead. Do what you want. Now, let's say you bought a home with financing, conventional financing, FHA financing. Usually you could move if you want to sell right away, you go ahead. There's no prepayment penalty for the most part. If you want to buy another one with financing, it could be done, but I will say the banks want to see that we want to see some monthly payments first. Nothing too crazy. I will say anywhere from 3 to 6 months. 3 to 6 months, which isn't that long. That's being realistic. You just bought a home, you want to buy another one. 3 to 6 months on average, if you qualify, we can make it happen. However, you often hear the term 100% financing or free money and all this other stuff. Some of those programs have restrictions. Some of those programs say you cannot move out for a year, up to 3 years, up to 5 years. And if you move out or sell, you have to pay that money back. That's why it kind of goes back to what I said. It depends on what kind of financing you got, what kind of I guess marriage you got in with the loan. Is it gonna have restrictions, not restrictions? What are you doing? Are you good to move in 2 months? Are you good to move in 2 years? I mean, it all depends. For the most part, though, most programs don't have no restrictions. You could buy another home within 6 months or at least 6 months. Some they might tag on a year or 2 years, just FYI. Another question we get is if you convert your mortgage into a investment property. For example, let's say you upgrade and you do not sell, but you're gonna go ahead and rent that property out, which is now your investment property. If your rate goes up, no, it shouldn't go up. Just because you're choosing to move out of that house and get into another house, putting a little down payment, 5%, you're not gonna get penalized by the first lender. They're not going to find out and raise your rate. It doesn't work that way. You are in a fixed rate mortgage for a certain amount of years. As long as you make that payment on time, you are good. Now, if you decide to refinance, and let's just say that the rates are higher at the time than when you originally got the home, at that point, yeah, your home could go up in rate depending on what you're trying to do, take out cash or whatever. So for the most part, no. Even if you refinance, it shouldn't too much, depending if you refinance at the right time. But I don't want to say no 100%. It just depends on the situation. Now, if you're finding a lot of value to the stuff I'm telling you, the stuff I'm teaching you, and you want to learn more tips and tricks and more mortgage hacks on how to increase your real estate portfolio, your wealth portfolio, please go ahead and subscribe to this channel. We're going to be doing more episodes. I'm going to show you more different tips and tricks, more mortgage ace hacks of how you can stay ahead of the game. Please subscribe. And if you have any questions or any feedback, or there's something that you want to hear me talk about, please put it in the comments, whether it's on here or on Instagram, so I can make sure to address it on the next episode. See you soon.